Hello, you're welcome back. Thank you so much for stopping by again. So, if you are watching this video, please note that this video is a continuation of the previous video. So, please try and watch that video before you watch this one because that video we're able to analyze the question and look at and point out some important things in the question. So in this video, we'll just be doing like practical, be doing preparing the reports basically. So I want you to understand. So for proper understanding, you actually have to watch that first video so that you would be able to flow, right? But that's fine. So let's continue. So you're welcome back to my channel. Please, if you have not subscribed, please don't forget to subscribe, right? And share this video with everyone and anyone you know will benefit from it. So let's start. So just like we have been analyzing November 2022 diet, right? So we're looking at the cover page in this video. We're looking at the cover page, the executive summary, the financial statement analysis, and the appendix on the financial statement analysis. So in another class, we'll talk about the financial data analysis and all of that. But I didn't want this video to be too long. That's why I just decided to just wrap it up and just do this particular just share with you these areas or this section in this video. So, like we read in our first class, like we looked at in our first class, we saw that we are preparing the report for the board of directors of Kudi Microfinance Bank (KMB), and we are actually working for Hexalinks Consulting Associates. We saw this in the previous class, and we're told to actually analyze the financial performance and the recapitalization options. So we just coined a title from those requirements, and from the two requirements, we just coined the title. So you can just say report on the analysis of the financial performance and capitalization options. If you want, you can say of okay, let's have some caps of KMB. That's just an option, or Kudi Microfinance Bank or KMB, as the case may be. Then a date May 10, 2022. Since like we're told to actually we're giving the reports on we're giving the email. The email was sent to us May 2nd. So just May 10, 2022. And since it's an external report, we have to include a disclaimer. So we have a disclaimer of this report has been prepared for the board of directors of Kudi Microfinance Limited. No liability would be accepted in the event of unauthorized use by a third party. So this is the disclaimer. So this is basically the cover page. And don't forget, you have to correctly number your pages because there is mark attached for it. So I just want to show you so you can see page 1 here, right? Although it has been pre-numbered, can you see automatically page 2, but I still have it here page 1. Do you understand? So now, before we go to the executive summary, I would like us to actually look at the body of work so that we can actually get okay, let me zoom this in so that you can understand what we're actually doing here, right? And how I actually arrived at that summary, because you're summarizing what you have actually done, right? So, all right. So, we're told to analyze the financial performance of Kudi Microfinance Bank from 2019 to 2021. Remember that we're told that the MD of Kudi Microfinance Bank gave us an additional draft financial statement for 2021, right? So, we're told to actually analyze the financial performance and everything. And before I continue, I want to let you know that we have different methods of analysis. We have the ratio analysis, we can analyze appraise project to next present value, we can appraise project through payback period. There's so many techniques that we can use. But when you're analyzing the financial performance of a bank, the best financial tool to use is CAMEL, 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 the CAMEL framework. So this is the CAMEL framework. And shortly, briefly, let me just tell you a little about the CAMEL framework. Although this is not a class on the CAMEL framework, right? But so that you can fully understand what we're actually doing. So basically, the CAMEL framework was adopted years ago, like maybe the 1700s or 1800s, I don't know. But yes, it's been quite a while that the CAMEL framework was adopted rather, and it's basically an acronym to assess the financial performance or financials of banks. So it's like CAMEL, like you understand. So don't look at it like, oh, camel, donkey, camel. Please don't do that. So the first one, the C, stands for capital adequacy. So capital adequacy basically talks about you assessing how adequate the capital itself. So that means a circular definition, right? How adequate the capital of the company of the bank is, because capital is very, very important. The company has to have equity. Equity is very, very important to run a company, right? And looking at the way CBN is giving them minimum capital requirements and all that, so there's need for enough capital to be adequate capital to be in the company, right? So capital adequacy is just you using financial tools to assess the adequacy of capital or adequacy of equity of the banks. How adequate is their equity? Are they actually, and the adequacy of the equity would would actually is an indicator to tell us whether the bank is at risk and the bank has capacity to absorb losses. Do you understand? So that's just basically what capital adequacy is like. We assessing the capital. So in layman terms, okay, for instance, let's say you have a business, a sole proprietorship business, and according to the regulators or the regulatory authorities of sole proprietorship business, you are supposed to have 10,000 naira as capital. That's 10,000 naira in your account or your bank. And so we as the financial experts or financial accountants now, so we have to use tools to assess, okay, this company, did they actually have up to 10,000 naira or more? Or do they have less than the minimum capital requirements? Or can they even cover their losses? Because if you are saying that you want to start a business that is worth 10,000 naira and you are having just 500 naira in your account, that shows that you're not even anywhere close to success. You're not even anywhere close. If any basic happen, okay, maybe basic, let me use the English now. If any problem happen or any debt comes in that sense, DEBT, that's debt, like you would not even be able to survive. Do you understand? So it's better for us to actually assess your capital adequacy. That's one financial factor, because can you survive? How? Do you have enough money? That is, do you have enough capital? Do you understand? So basically, that's just what capital adequacy ratios actually consider. The second one is asset quality. So this asset quality is just assessing the condition of the assets base. Like, what's the condition of the assets base? Do you understand? What's the condition of the assets base of the company? So basically, we're just assessing the condition of the assets base. What's the non-performing loans? You understand? Here, we'll be looking at non-performing loans. So non-performing loans, like I explained in the previous class, non-performing loans is just like the loans that, like, want to assess, are borrowers actually defaulting their loan repayments? Are they actually performing well? Do you understand? So performing loans, not performing loans. Performing loans is basically the one that, people are actually paying their money on time, like the loans that they are collecting from us, that they lend from us, right? And non-performing loans is just like loans that borrowers are actually defaulting. So that's just basically asset quality. We want to consider the asset base. What is the quality of the asset base of the bank? Then the M, that's like management capacity. So in this one, now this is like a qualitative factor. So we don't actually need any much, what's it called now? Much calculation, yes. Much calculation when we are assessing the management capacity. This one is just, okay, how well is management performing? How well is the capacity and everything? Because it's not just all about having money as capital. It's not just about having a good capital base, but it's also important to have human resource, right? The good management, the good people that are actually capable of actually taking us to success, right? So the E is the earnings. Earnings is also profitability. We're supposed to be assessing the profitability. What is the profitability situation of the company? What is the ability to generate profit, use return on equity, return on assets, just like the normal profitability ratios that you know. Although this one I'll be using we'll be using some financial, like, okay, some line items or some information that is not like normal, like you get. So we'll get to that. Then liquidity, just like normal liquidity, what is the companies or the bank now, the bank's ability to meet short-term obligations when due, and all that. So this CAMEL framework, the capital adequacy, the asset quality, management capacity, the earnings, and the liquidity, these are the areas that we actually need to assess when we actually evaluating a company, a bank, in that sense. So that's just what I just wanted to let out there. So the just financial, so we give an introduction, like we say, just like we did in our previous financial statement analysis class. So we give an introduction. So the just financials of Kudi Microfinance Bank for the year ended 2021, December 31, 2021, and financials for 2020 and 2019 were reviewed. So this one, so we have just financials. That's the one that has not been audited, and the other ones are audited for 2020 and 2020 and 2019. So we reviewed the three. Then the financials of 2021 have not been audited and cannot be fully relied on. So you have to actually state it there. That's like a professional skepticism, a questioning mind. You are actually questioning it, and it's going to this, in fact, you will score high points. actually analyze. So when you see that they are telling you something about management accounts, finance just accounts, unaudited accounts, make sure you point it out there that these accounts cannot be relied on. Any analysis cannot be relied on because the not all the time is the unaudited financial statement the same as the audited. Do you understand? So in case there's any significant change in the audited financial statement, they're not setting it out there. So they don't want to arrest you that are you the one that said you are making profits? And meanwhile, when you audited the financial statement, you saw that they're not actually making profits. Do you understand? So you have to let it out there. So the first one was capital adequacy. So let's go to the appendix section before we actually look at the explanation. So I explained here that the information used to carry out this analysis was extracted from Exhibit 5 and Exhibit 10. The non-performing loans and total loans are in Exhibit 11, just so that you can know where I actually extracted this information from. And like I've already explained the CAMEL framework. I also said that M is measured using qualitative factors, so we cannot calculate anything here. So capital adequacy ratios, then I just analyzed it like this, then I gave you like tables and everything. So this is quoted in thousands. So one of the capital adequacy ratios we have is the capital to loan ratio. So the capital to loan ratio, so you know capital to loan, that's like your equity over your loan and advances. So and this is in percentages. So your equity for the year, June of 2021, all over the loan and advances, then you do it for 2020 and 2019 as well. Now if you notice the pattern, now in 2019 we had 87%, in 2020 70, in 2021 52. So that's like a significant decrease. So that's like indicating that wow, these people they don't even not have enough capital. Excuse me, they don't have enough capital, right? They don't have enough. So that's like a big problem. But let's look at one ratio does not summarize everything, right? So let's look at other ratios. So you have the capital minus intangible assets ratio. So capital minus intangible assets ratio. So let's look at it. So we have here. So when we did it, so just basically the capital minus intangible assets is always on the you can find it on the financial statement as well. Then we had in 2019 we had 15.42, but it's actually good. It's actually increased in 2020. I remember that in 2020 we had a capital injection of 400 million plus. Remember, right? We had a capital injection. So basically, this is most likely because of the capital injection. But unfortunately, we had a loss, not even loss, basically. We had a reduction again in 2021. I remember that when we looked at the financials, we saw that in 2021 there was an additional retained deficit that actually reduced our equity. So this is actually showing that okay, even though it increased in 2020 because of the injection of capital, there was still a reduction because of high retained deficit. So that's a problem. If you also look at the capital to total assets, so you can see 15.48, it's increased again because of the capital injection, but it's also reduced again. So let's go and interpret this now. So you have the capital adequacy ratios. So this is it here, yes. Capital adequacy ratios. So the let me just separate this so that it's not be jumping up. I'll put it back, but just for you to see. So the capital adequacy ratios were used to assess the capital structure of KMB and its ability to absorb losses. Okay, I've explained it earlier. The capital adequacy ratio just assesses the capital structure and the ability to absorb losses, because if you have enough capital in the company, you'll be able to absorb losses as I went due. If anything happens, you can go to your boss and take your capital, right? But if you don't have enough capital, you cannot absorb losses. So in simple terms, it shows the financial capacity of the bank and the potential to cover losses. The assessment of capital adequacy of KMB revealed that KMB is experiencing capital adequacy problems, and there's another need for capital injection. There is serious cost. How can you tell me that you moved from 87, a whooping 87% down to 52%? That's a significant problem, like a very, very big problem, right? So that's like a capital adequacy problem, and there's a need for urgent capital injection. Failure to inject sufficient capital and meet the minimum required capital can make it lose its license. Because now they are telling us, according to what we read in our first class, we're told that the minimum capital requirement for a state microfinance bank is 1 billion. And currently, as of 2021, KMB has 300 million. That's like almost 600 million plus problem that we're looking at, right? So there's a need to inject capital ASAP. If not, we would lose our license. So the capital to loan ratio was in decline as it reduced from 87.56% 2019 to 52.30% in 2020. And this can be seen in appendix. So remember when we talked about our class when we talked about appendix, our class on appendices, where we talked about you linking. Please, if you have not watched that video, make sure you watch it. How to link your work and your appendix together. Please do that. This implies that KMB's capital base is diminishing and is at risk. Hence, KMB has less ability to absorb losses. The decline in capital to loan ratio also further proves that KMB has not met the minimum capital requirements by CBN. The capital to total asset ratio slightly increased from 15.48% to what? To 19 in 2019 to 24.28% in 2020. Due to what? Due to capital injection. So you can see that it's actually increased. You actually saw that it increased, right? Due to the capital injection of 400 million plus. However, the capital to asset ratio declined again in 2020 due to the high retained deficit that reduced the total equity. The capital less intangible assets to total asset ratio also follow the same pattern. Do you understand? So you can see that as I'm telling them it's reduced, I'm telling them why. I'm telling them a major problem is capital insufficiency, and which is as a result of what? The high retained deficit that is eroding the equity. Yes, they are injecting capital. There's capital insufficiency, and they actually injected capital, which was a good move. But they also need to take care of their retained deficit. And like we saw that operating expenses is actually the major reason. Because at the point when we got to operating expenses, that's when we started having loss. So there's a need to actually have all these problems reassessed. So you're not just telling the company there's a problem. It's increased to decreasing rate from increasing rate. Don't you say you cannot interpret. You cannot interpret increase from increasing rate to decreasing rate to increasing rate. Don't tell them that. Give them a reason because we are actually preparing a report as a chartered accountant. We have to give them a reason as to why that actually happened. Do you understand? So that's just basically about capital adequacy. The second one was what? The asset quality. And like I explained earlier, asset quality basically is just to assess the condition of KMB's capital base. So now let's go and look at the appendices on asset quality. So asset quality, we have non-performing loans. The non-performing loans. So how did I arrive at these non-performing loans? I'm not just here to just give you figures. I'm going to show you how. So this is note 1. So we have the total loans comprise of performing loans and non-performing loans. And I've explained that performing loans are those loans that borrowers are actually repaying, and non-performing loans are those that they're actually defaulting. So now let's now go to I attached the exhibit below so that you can see. Okay, I think it's here. So exhibit 11. If you look at exhibit 11, statement 2, you can check that out when you download the past question yourself. So you can see that our performing loan for 2021 was what? 92,120,000, right? And we had 3 non-performing loans: 205,000, 207,000, 133,500, quoted in thousands, right? And for 2021, the gross, we had performing loans of 410,876. Then we had non-performing loans of 202,800, 177,982. So now let's move up again and actually consider it. Let's go. Yes, that's okay. So let's go back. So if you see it from here now, yeah, from here, my notes 1. So this is where I calculated it so you can see. So we had the total loans equated to it was equal to the what? The performing loans and the non-performing loans. So let's use that color here. So you can be using pink. But that's just by the way. I want to point out something here so that you can understand, because I want you to be able to be confident that if they tell you come and analyze a bank's case study, you are not like, oh my god, what do I do? I want you to actually have an in-depth understanding of it. Do you understand? So that's why I'm highlighting it. So now we can see that our non-performing loans, like we saw, 205 plus 702 plus 133 gave us what? 545, right? And our total loans, that's the non-performing loans, the performing loans rather, plus the total non-performing loans gave us the total loans. And the non-performing loans for 2020 we added the 3 and plus the performing loans of 410. I don't know if you can remember what we did. So here the total loans is 637 and for 2020 791. So you can see that from here. So 637 for 2021 and 2020 791. So I just wanted to let you know how I actually arrived at the non-performing loans figure. So that figure of 545, 740 and 387 38782. That was what I used to calculate here. So one of the asset to assess the asset quality, the ratio is non-performing loan ratio. So we have to assess, okay, how if you want to look at the quality of the bank's asset, the asset base, you have to look at the non-performing loans, like the loans that they are defaulting. And the formula is the what? The non-performing loans all over the gross loans. That is basically you're looking at the proportion of non-performing loans in gross loans, because the gross loan consists of the what? The performing loans and the non-performing loans. Can you remember here? Can you see that the total loans is what? 67, right? The total loans here is what? 791. And that was what I used to, that's what I divided. So that means I'm looking at the proportion of non-performing loans in the gross loans, because gross loans equate performing and non-performing loans. So here we have 85.56 and we have 48.10. So we could not find this for 2019 because we're not giving information about that. We're only giving information about 2020 and 2021. That was why we actually just calculated for 2020 and 2021. So the second one, we have another ratio that we can use to assess the asset quality is the loan and advances to total assets ratio. So the loan advances, basically, so it's just straightforward. The loan advances, we have its total asset ratio. And non-performing loans, let's even analyze it. Can you see this problem? As at 2020, we had 48%. As at 2021, we're having 85.56%. That means, in summary, as at 2020, we had 48% defaulters. As at 2021, we now had 85% defaulters. So that's like a significant leap for the company. How can the company even make money? How can the company be liquid? So even before we even check the liquidity ratios, we already know that the company cannot be liquid. We already know the company cannot be liquid because the company is actually experiencing a very, very big problem. A very, very big problem, in fact, a major significant problem, because this is 85% to 48%. And if we look at the loan and versus the total assets ratio as well, you can see it from 17% to 43%. So this is like a big problem. So now let's go and interpret. This company has issues, but that's why we are here to help them solve the issues, right? As experts. So asset quality was used to asset quality ratios. We can just put it here. Asset quality ratios were used to assess the condition of KMB's asset base. The non-performing loan increased, the non-performing loan ratio increased from 48.10% in 2020 to 85.56% in 2021. We linked it to Appendix 1. This implies that more of KMB's borrowers are defaulting on their loan repayment. A non-performing ratio of 85.56% implies that KMB has high credit risk and non-performing loans have not been adequately provided for. That means they're not even providing for non-performing loans because you actually have to make provisions. KMB needs to set aside provisions for potential loan losses because this is a problem. So they need to actually set aside provisions. And the total non-asset ratio slightly decreased in 2020 to 32.88% to 2021, which implies that they actually lent a smaller portion of their total assets. But that they are not performing loans, they have to urgently look into it. That's about asset quality. Then the next ratio we're going to be looking at is the profitability ratio. Do you understand? Profitability. So let's go and look at the calculation as well. So we have the profitability ratio. So the net interest margin ratio is the net interest income over total income. So net interest margin ratio, basically, I'm looking at, okay, what is the proportion of net interest? Now, what's net interest? What's the difference between net interest income and interest income? Interest income is like the gross income that the company or the bank derives from interest. But net interest is now the gross income deducted by any expense that they have incurred. So the net interest income, we're looking at, okay, what is the actual proportion of the net, what is the, that means in summary, what is the actual interest income you are receiving? Because if you're telling me that you are receiving a revenue of 1 million naira, that is not actually your profit. Do you understand? Your profit is your revenue minus cost. Because if you're telling me you're receiving a revenue of 1 million naira and you're incurring a cost of 2 million naira, then you're not profitable. You're actually a loss company. You're actually incurring a loss. So this is like more like you're saying the profit, kind of, not really profit, but kind of, because you're doing the gross minus the expenses. So look at the figures are in the financial. So you can see that we had 90.98%, it reduced 23%, it now further reduced to 46%. That means the company is not even, like, there's a problem with profitability here. The return on equity too. Now, before we look at return on equity, now we have to actually do some calculations. Remember that we're told by the auditor that the company is not actually following IFRS 9, the provisions, right? The provisions of IFRS 9. So we have to actually have some adjustment. So now this is where we are. So let me take this out. This is not needed. This is not necessary. So let's take this out. Now, PNB, their Kudi Microfinance Bank, used IS 39 and did not adopt IFRS 9 until 2021. So it was 2021 that they adopted IFRS. So if you are wondering that, oh, why are we adjusting the figures of 2021 and we're not adjusting the figures for 2019 and 2020 and 2020, is because PNB started adopting IFRS 9 as at 2021. So we don't need to actually adjust anything for 2019 and 2020 because as at then they were not actually using IFRS 9. Do you understand? So that's why we're actually adjusting for only 2021. So IFRS 9 is forward looking. You understand? So what do you mean by forward looking now? It considers expected credit loss. So I'm going to explain. Just don't worry, I'm here for you, okay? It considers expected credit losses, but IS 9 considers only incurred losses. It considers only incurred losses. So IFRS 9 considered expected credit losses. IS 39 considered incurred losses. So now, what does this mean? Now, there are always losses are always incurred. Do you understand? Like we always incur, like, oh, maybe additional loss as a result. Like if you look at this now. Now, this was where the computation was done, right? This was where the computation was done. So, provision for loan, losses on loan. Do you understand? So, there was like an impairment, like a loss that the company actually incurred. Do you understand? On the loans. So, you have to actually make provisions on them. So, those provisions that we're making on losses, do you understand? On losses. Now, according to IFRS 39, you only make provision for losses that have been incurred, losses that have been incurred. So that you understand, we're not considering future loss. But IFRS 9 considers losses that are not expected losses. Expected losses. So now let's go back. Let's go back here. Yes. So now IFRS 9 is forward looking. Do you understand? It considers expected credit losses, but this one only considers incurred losses. So obviously, IS 39, the loss that IS 39 would compute, and the loss that will compute using IS 39 will be less than the cost that we compute using IFRS 9, because IFRS 9 is saying that, oh, both the ones that have incurred and the ones that we're expecting to incur, all the losses on loans, we should consider it. But IFRS 39 is saying that only the ones that have been incurred. So we have to actually consider, because impairment loss would affect the profit and loss account, because it will reduce the profit and loss account. It's like an outflow. Do you understand? So if you're having an impairment loss, so think of it like an expense. So now look at it like this. Let me give an example. So if you're saying that, let's use salary. I'm trying to use something that you can relate with. So let's say salary. So let's say IFRS 9 will consider the salary that you are paying this year and the salary you are paying next year. That's current salary and expected salary. But IFRS IAS 39 will consider only current salary. So let's say we have a gross profit of 100,000 naira. right? And salary which is an expense, right? So we do gross profit minus expense, right? Will give us what? Net profit. Share. That's right, Abi. So now, hope you are noting this down. So now we have a gross profit of 100,000 naira. So if we are saying that we're paying our employees 10,000 naira every year, that means for this year, if we're using IAS 39, which only considers losses that have been incurred, that means we have 100,000 naira minus 10,000 naira, which will give us a net profit of 90,000 naira. But if we are using IFRS 9, we'll be saying, oh, the total salary will be 20,000 like that, right? That's 10,000 for this year and 10,000 for next year. So 100,000 minus 20,000 will give us 80,000 naira. So that implies that the profit that's profit after tax, right? Or let's just say, okay, the net profit in that sense. The net profit that we would have using IAS 39 will be higher or greater than the profits that we have using IFRS 9. Because in using IFRS 9, we have considered both incurred and expected credit losses. So now, coming back to provision for loss, like provision for credit losses, now coming back to it now. That means if the company has been using IAS 39, that means it's safe to say that the profit is overstated. Because they've not actually considered future losses. They've not considered that 10,000 naira extra in that sense from the example we used. So you actually have to consider it as well. So it's going to reduce the profit. So if we're doing any calculation using profit after tax, like now return on equity now, will be profit after tax over total equity. So if we're doing any computation using profit after tax, we cannot use the overstated one. We have to actually adjust it for the extra impairment loss. Do you understand? So that's why. So now, Exhibit 11, Statement 1 shows the reconciliation of impairments based on IFRS 39 to IFRS 9. According to IFRS 9, in 2020, the impairment provisions were 159,720,000, and IFRS 39 was 43 million plus, which implies an impairment impact of 116,335,000. Do you understand? So this is an extra. So now let me now show you what I'm talking about. So that was the reason why I actually added this exhibit in this place. So now look at it now. Can you see this? So now, according to IFRS 39, they're telling us that our impairment loss is 43 million. But now IFRS 9 has increased it by 116 million naira plus. So that this addition now we actually have to consider it. Do you understand? But not something. Here we're told in statement 2 that we have other known losses of 12,235,000. And known losses are what? Incurred losses. That's losses that we have known, like just like I used for the salary. Salary for this year is 10,000. So that's a known loss already in that sense. So this known loss that we have here is not insignificant though. This loss now is like the loss incurred. Do you understand? Do you get it now? Hope you get it. If you have any question, please let me know in the comment section, okay? So this now is a known loss. This is an extra loss, other known losses. But now, apart from that, we have impacts of 166,000 because of IFRS 9. So now let's now go to our calculation. I hope if you have any question, just let me know in the comment section, okay? But I tried as much as possible to break this down so that you can understand. All right. So now, if we are having, let's just leave all that. So now, if we are having expected losses according to IFRS 9 to be 116 million. So let's put this in brackets so that we can. That's good. Now we're having expected losses of 116,357. You have seen that, right? But now we know some losses already. So now if you're telling me that okay, the expected salary is 20,000 naira, but then we already know that we're paying 10,000 naira. So that means we actually that means if when you say you're making provision for something, that means you're providing for something that has not yet happened, something you're expecting, right? So if you're saying that okay, the expected losses the total expected loss that we have is 116,357,000. But we already know we actually have no losses of 12,235,000. So look at it from the point of bad debt and provision for bad debt. Now, bad debts that have been has already occurred, but provision for bad debt is what you have not yet. You understand? So let's say you lent Mr. Taye 5,000 naira, but okay, you lent Mr. Taye and Mr. Kehinde 5,000 naira each. So now that means what? You have to make a provision for bad debt or something of 10,000 naira, right? Because you don't know if they'll pay you. But peradventure, unfortunately, Mr. Taye now died. So that's like a bad debt already. He has died, he has gone. So that we cannot be providing for 10,000 naira again, because that would like overstatement. You're overstating your provisions, because you already know that 10,000, 5,000 naira and that 10,000 can never be recovered, probably the until judgment day, all right? So now you have to reduce that provision. So you now do 10,000 naira minus the 5,000 naira of Mr. Taye that died. So actually, the provision you actually have is what? 5,000 naira. So that's just what we're doing here. We know that our expected loss is what? 116 million naira, 357,000. But we know that we have losses incurred and known is 12,235,000. So that the actual net payment loss, the estimate loss that we actually have is 104,112. So that this one now is what? Is think of it as an expense to reduce an outflow. Let's just say an outflow, an extra outflow in the profit and loss account. So, and you know that this thing, we're calculating impairment losses, I mean now non-impairment losses on financial assets, right? So that if I'm saying that, so now that's just saying that we're going to be debiting it to profit or loss. You know, if you're debiting profit or loss, it's an expense. Do you understand? We're debiting it to profit or loss. That is increasing the expense, right? Then what? We are going to be crediting it in assets, because impairment is on assets, right? So it's going to also reduce our assets. And and you don't forget that the profit, if we're adding additional expense in the profit or loss account, then the profit will also be affected. And if profit is affected, the equity will be affected, because the profit after tax is included in retained earnings. And retained earnings is a part of equity. So now let's take it small by small by small. So that I don't want us to be confused. That's why I'm trying to break it down. Now the next payment loss will be deducted from profit after tax in the SOPL and from financial assets in the statement of financial position. And the profit or loss will be added to retained earnings. So you can write this down out, and it also affects equity. So summarily, this figure 104,112 will reduce the part. It will reduce the carrying amount of assets, and to also reduce equity, because parts will be included in equity. So now we have adjusted parts. So our current part, so let's take this down. All right, that's good. So our current part is, if I were even making a loss already of 200,727,000, and we have an additional net payment loss. So our part is, so if you had used this figure to calculate when you are using, like you're considering part for 2021, you'll be wrong, because you actually have to. So all this information they're giving us is not just for us to just dive and just information about it. No, it's important. So the adjusted assets to 170, then so the net impairment loss also affects the assets and also affects the equity. So this will be our adjusted equity, our adjusted assets, and our adjusted parts. So now let's now go back to our calculation. So we just did all that for this figure. So we have profits for the year. So instead of the part of two, instead of this part, this one here, instead of this part, this one here, we are using this one here, 304, because that's the adjusted part, right? We're using that one there. So that's what we have here. Then we have the profit or loss divided by the equity. I know this is adjusted equity. We're using two, right? Because we have calculated it. Then you also do the same. But if you look at this now, the return on equity, 3%, 2019, minus, it's a problem. With profitability, additional indication that there's a problem. Now, if you look at the return on assets as well, is also reduced. So this is a problem with profitability. So let's go and analyze it here. So, all right. Then the earnings or profitability ratios were used to assess KMB's ability to generate profit. The decline in net interest margin ratio from 90 90%, can you see this company? 90% in 2019 to 43% in 2020. In fact, that's a huge leap. Implies that KMB is incurring more costs on borrowings and deposits as compared to the interest income it receives. The return on equity and return on assets also declined to 136% and 60% respectively. And this was due to the loss incurred. Do you understand? So that loss, that additional loss that we calculated, do you get? So it's further increased the the decline. It further contributed to the decline. KMB did not follow provisions of IFRS 19 until 2021. Hence, the additional provision for impairment loss was recomputed to feature the provision of IFRS 9. The impairment impact of 104,122,000 also affected the profitability of KMB. The profitability ratio shows that KMB has a low potential to generate profit. The weak profitability states because the expenses incurred on operations and interest have not been properly managed. I think I've actually highlighted that already before. KMB needs to adopt control procedures to reduce costs that is reducing profits. So now finally, let's look at the liquidity finally and sharply. So the loan to deposit ratio, if you look at it, this is like a liquidity ratio we can use. Can you see 21% decline? It increased a bit to 52%, then also declined again. The cash to cash equivalent as well, it decreased, but this one even decreased, steady decrease. And the cash ratio also had a steady decrease. So that's the problem. No, I almost said that the company will obviously have liquidity issues because we have telling me they're having a non-performing ratio of 48, it increased rather to 85. That means you don't have money. People are not going to pay you back money. So that's the problem. So we already knew that the company will have liquidity problems, but we just have to still calculate, right? So the liquidity ratios were used to assess the ability of KMBs to meet a short-term obligation, and then we can see that the ratios increased in 2019 to 552 points in 2020, which implies that KMB had a higher lending in relation to its deposits in 2020. However, it also declined. And this was because of the regulatory capital requirements that reduced capital available for lending. So the company did not have enough for lending because in 2020 they're actually looking for more money, so they cannot be lending money out, right? So that's why it's actually reduced for that. Then the liquid assets to total ratios also declined. And this also implies that KMB has a lower proportion of liquid assets, which is the cash and cash equivalent, as compared to total assets. So they have a lower proportion of liquid assets as compared to total assets. I already know why. People are not paying money back, not performing loans, right? The cash ratio also followed this pattern. The liquidity ratios of KMB showed a downward trend rather, despite the cash injection in 2020. Because in 2020 they actually injected shares, but despite the cash injection, they showed a weak liquidity position. And the weak liquidity position is because of the high increase in non-performing loans. Do you understand? High non-performing loans result in low interest income, right? Which is the major source of inflow to the bank and higher provisions for losses, which leads to poor liquidity. So that's just basically about it. So you also make a conclusion. Oh, the capital adequacy ratios were on a decline. I think we've looked at all that already. KMB needs another capital injection, in fact, and you can also tell them too how rights issue. Fine, yes, you just told us that directors actually injected shares, but there's this one. I think they still need more injection. So through rights issue or issue of new shares, right? The profitability position of KMB is weak due to high operating costs and interest margin. You get to have actually looked at that. And KMB needs to control costs to increase its profitability. The high retained deficits decrease the total equity of the company. The non-performing loans weaken the liquidity position of the KM. So you're just like summarizing everything. Therefore, risk management practices should be adopted. And you recommend, right? Cost control, they should control operating costs. Like that one, they will need significantly because operating costs is the one that is actually causing the problem. That's the genesis of the problem. And they need to inject more capital. And they need to properly adopt the provisions of IFRS 9 and address high non-performing loans by adopting credit risk management. So if you look at this now, if you look at this now, they're not just they're not just what's it called now? Telling them do this, do that. You're actually telling them how, why. Do you understand? You're telling them how and why. So that's just basically all about the financial statement analysis. That's just basically all about the financial statement analysis. And then you actually do a summary, an executive summary. You understand? But we'll talk more about the executive summary in our subsequent classes. But let's just look at it briefly here. So you just look at it. Oh, tell us what the report was about. Then tell us the information. And this is like summarize requirement one and requirement two. Talk about it a bit. Then the objective of the report. You also have to talk about it. Oh, to provide this full information, right? We talk about it, provide this full information. Then the methodologies that you also use for the report, we talk about that. And you summarize all what you have done in a financial statement analysis. You give a summary of it. Can you see? This was a summary of the capital adequacy ratios. Then you also summarize all other ratios that you were asked to do. We talked about the non-performing loans, the return on equity, return on asset. Then this one is the financial data analysis. We'll talk about that in the next class. Then you give your conclusion too. You summarize the conclusion of both requirement one and requirement two, and then you give your recommendation. So that's just pretty much all about this class. I hope you learned a lot. I hope this class was helpful, and I hope you actually enjoyed this class as much as I enjoyed recording it. Please, if you have not subscribed, please don't forget to subscribe. Please share this video to as many as you can. Like this video, and I will see you in my next class. Have a lovely day. Bye.